and welcome to Moneycontrol. Well, part of our Diwali special series, I have with me an investment stalwart, the CIO of Prudential ICICI Mutual Fund, S. Naren. Naren, thank you so much for your time today. I mean, this is really precious. Thank you so much.
Wishing everyone a very happy Diwali.
Thank you, thank you. So, what I wanted you to do, Naren, this time is to just, traverse the last 1 year and tell us how has this year been in terms of making money? Because if you look at the market, the Nifty has really not gone anywhere. It's just up about 3% last Diwali to now. But it feels like the market went all over the place. It went higher, then it went sub 17,000 in March, and then there was this mid-cap, mad-cap rally. And now we are, 19,000 thereabouts. So lots of ups and downs, but in the end, you're at the same place. How has it been for you as a fund manager?
So it doesn't feel like that, I think if you have had such a big move in mid cap and small cap, maybe you don't feel like you're in a flat market or something like that. I think we have had one of the fairly bullish markets at this point of time, and I would say that the markets have done pretty well over the last 1 year. It is just that the mega caps have done pretty badly, and the mega caps, everything else has done very well over the last 1 year. And overall, you don't get that feeling, that markets have done badly, and that's not the way you feel, because almost every stock that you look at looks to be trading at 30 PE,
right,
and doesn't seem to be trading at low valuations.
Correct.
So having been in investing for long, when you try to look at stocks at this point of time, you don't get the feeling that
the market's not done anything.
Market is not is very cheap or something like that. You don't get that feeling at this point of time.
Right.
So I don't get the feeling that you're in the midst of a bear market or something like that.
Tell me, rewind back to, let's say, last October or March, if you can recall, because I certainly agree with you that last few months, the frantic rally we have seen obviously makes us feel that, a lot has happened in a very short time period. But the rest of the year actually felt the opposite. In March, it was like, what is to come? Could it be the next 2008 and so on and so forth? How challenging was that period? And thereafter, was this period a super surprise?
See, everyone wants to equate everything with 2008. I think it is completely illogical. See, 2008 was special because a lot of things which happened in 2008 was unprecedented and may not happen on so frequently. And I think, to expect the markets to fall 50%, you need to have done a lot of mistakes. And I think Indian macro has been managed very well. I look at some indicators like, let's say, I look at current account deficit, I look at inflation. Look at current account deficit and inflation, it has been managed in a very, very sensible way over a long period of time. When you have this kind of a situation, you're not going to have 2008. So to equate everything with 2008 is very unlikely. I think basically what has changed is that, everyone has focused their asset class on equity. So you have a very, very buoyant SIP inflow. You have so much of money coming from EPFO on a monthly basis into equity. You have a lot of money coming in from NPS, National Pension Scheme,
Correct.
into equity.
Correct.
You have so much of money coming into equity on a regular basis
Right.
that it becomes, it's illogical to expect very large, big drawdowns in large cap equity at this point of time. So that's why I think the markets are different, and today the incentives which are there for investing in equity are much better than the incentives which is given for it, let's say investing in debt. That almost every investor wants to invest in equity.
Correct.
And not in any other asset class at this point of time.
So you're bringing for two things, but let me take one by one. One is that you're saying that the risks in markets today are not as as it was in 2008, primarily because you have a counterforce in terms of, domestic flows. Fair enough. But in terms of global macros itself, do you think there are any risks, or are those also exaggerated? Because the fact is also that the kind of interest rate rise we have seen in the US is absolutely unprecedented, right? I mean, when did you have an episode like this last? It was in the 80s, and such an accelerated. So those also create, and the debt levels at that time, the leverage was in the bank balance sheets. Today, the leverage is in, the biggest economy of the world, or, other world economies. So how do you size up this risk, and how do you reassure yourself that we are not in for some really deep correction? That is number one. So the global risk, how do we feel secure about it? Second is, of course, the India part, which we'll come to, but tell me about the global thing.
See, if there were no problems, that is, then we are not in a proper market. So I think you will periodically have problems. If you look at the kind of problems that we have had in the last 2 years, someone had told you there will be a Ukraine war, there will be a Hamas problem, there will be oil shooting up, you will have interest rates shooting up, and people will tell you that the markets will not go down. Maybe I would have said, no, markets will be down. It didn't happen. So I think basically, markets are pretty resilient. Even across the world, I would say markets have been resilient. Because I think overall, people enjoy equities as an asset class today, because it's a liquid asset class. And over a 10-year period from 2010 to 20, I think people did make money in equities as an asset class. So somewhere equities is a favored asset class of people, and I think that has had a role to play. I think that's why markets have been more resilient than what we would have ever thought of, given the kind of problems that happened. And that's why, I always think that if interest rates were to go from 0 to 5, as it has happened in US, why is it not that more people are not investing in debt in the Western world? It's not happening. Or it is that, there has been so much money still printed. See, after all, US printed not $1 trillion, printed multiples of trillions of dollars.
Correct.
And they have still not removed that trillions of dollars.
Yes.
That is the reason inflation doesn't go away so easily.
Correct.
Maybe that's the reason why even today markets are resilient, because they have not removed all the trillions of dollars that they have printed. They are trying to remove some small amount of money which has removed out of the trillions of dollars printed.
Yes.
That's how maybe I look at it.
Sure. And in terms of India itself, do you see any risks? But more importantly, you touched upon, when we started this conversation, you said that it doesn't, if you look at stocks, it doesn't really feel like it's a cheap market. So it is not a cheap market is one side of the story. And there is a lot more money that is coming in to support the markets. And, every month this new money is coming into mutual funds, NPS, and all of that is another part of the story. Is there a need for, people who have been in the markets for 20 years, or even today you look at all these historical P's and say last 10 years this was the P, last 20 years this was the P, and today we are 50% higher than that, or 30% higher than that. Is it even a fair comparison? Is there a need to completely reset our thinking in terms of what we are equating today's valuations to?
I think you're using the word this time is different. Those are all words you should never use.
Right.
I think it is.
But then this new money flow that is coming is indeed different, no? Or do you think it is not? Can it reverse?
New money is different, I agree. But at the end of the day, it is built on the fact that people think that equity is riskless. So the moment people think that equities have risk, then money will change. So I always think of credit as an asset class in India. Till 2020, people used to invest in credit funds and mutual funds. After 2020, there's no money in credit. It is not that credit is a bad asset class. But no one wants to invest in credit now. So I believe that, people are always conditioned by the past. So after 2011, there has not been a down year in equity per se.
Yeah.
So if you don't have down years, again for some more time, people come to a conclusion equities is riskless.
Yeah.
Then obviously more and more money chases. That leads to even higher markets. But that doesn't mean that it is markets are more safe. Markets are less safe. When people think that markets will never go down, it is less safe. So in different meetings, I tell them it's possible markets can come down sometime by even double digit. And people start doubting me as though I'm talking something which is illogical.
Right.
So that is the irony at this point of time. But having said that, let me tell you what is at the heart of this reason. The heart of this reason is macroeconomics has been managed very well for a decade. So when you manage macroeconomics well, some of the problems disappear. So if you manage macroeconomics badly, let's say current account goes into bad shape.
Right.
Inflation goes into bad shape. Let's say fiscal deficit cannot be funded properly.
Right.
Then, you have a disaster ahead. That has not happened for a decade. So I believe that if at some point of time in the future, the macroeconomics gets into trouble, we will have big corrections.
Right.
Actually, if you see across the world, there have been many countries where the macroeconomics have been managed badly, and then you have had big corrections. So if you look at even US, why did interest rates shoot up? Because they lost control on inflation.
Right.
So I think it's one of the key things which I tell people is the macroeconomics being managed well is very important for markets to be well behaved. So even in countries like US, macroeconomics was not managed well enough. And that is the reason why inflation went up and interest rate shot up in many countries in the world. Whereas in India, interest rate hike has been very, very little because Indian macro has been managed much, much better.
Right. So is that if at all we were to think about risks, is that the biggest risk you see, or is there anything else?
See, from an investor point of view, the risk in India is not macroeconomics. From an investor point of view, the risk in India is valuation is very high compared to any other country in the world. So, but that is macroeconomics is not the risk in India. Higher valuation relative to the world is the risk in India. That is a risk, and such risks no one can predict when it will play out. So it's very nice for me to say it is a risk, but I won't be able to tell you when high valuations results in money leaving India and going into some other part of the world. I can't predict that because the reality is valuations can stay longer, higher, because it's not under our control, because India is a good structural story. So when you have a good Indian structural story, you can have valuation stay higher for a long period of time. So you can't predict. First of all, it's very difficult to predict risk, and it's very difficult to predict the timing of the risk. So I think both are difficult, and that is the reality of what we have seen.
Sure. So how do you approach it? Because on one hand, you're saying that stocks are expensive. On the other hand, we are unable to see triggers that will, bust this, if at all. So how do you do this?
That is too simple, actually. In fact, if you had asked me this question 15 years back, I wouldn't have been able to answer. It is too simple. What we have learned over a period of time is we created categories like balanced advantage. Then there are categories like multi-asset, equity and debt, equity saving. These are very, very simple ways for investors to invest in. If you invest in these categories, you don't need to over worry about these risks, because no one knows when these risks will play out. The past experience says that these are easier ways to invest in the market when you know valuations are high and you don't know when the higher valuation will actually affect market. Choose categories which are slightly riskier than equity for lump sum investing, and then you don't need to worry. So I would say it's very, very easy from the point of view of an investor. From the point of view of a fund manager, it is simple. Focus on the larger companies, focus on the mega companies, which have not delivered any returns anyway.
Right.
So you get the more liquid companies, which are cheaper and who have not delivered any returns for 2 years.
Correct.
So choose those companies over the very small companies that have delivered huge returns and who are actually much more illiquid if you had to go and sell them in a downturn. So that is the second aspect. So it's easy both as a fund manager and it is very easy as an investor.
I'm very sure it's not as easy as you are making it out to be.
It is very easy. But the fact is that you can't look at your portfolio every day and measure yourself whether small cap has gone up. Yeah. Every day you cannot ask yourself, why did this mega cap not go up as much as a micro cap? So in reality, it is easy. It is just like in 2007, it was easy to bet on value investing over infrastructure investing. In 2020, it was very easy to bet on value stocks over, let's say, quality stocks. It was very easy. But if you expect that the next day the return will, the whole idea will play out, it wouldn't have played out. But eventually it played out.
Correct. So the story about mid-cap also, now that they have done so exceptionally well over the last few months, there is this new narrative that this time, usually only at the fag end of the rally do you see mid-caps and, small caps rise really sharply. But now there are a number of investors I talk to say that, this time this rally has, stronger legs because there is something fundamentally that has changed and their longevity is more assured this time than last time. In your eyes, has something fundamentally really changed for a broadening of this rally?
So many times you're using the famous words, this time is different, actually.
Yes.
You're not using those 4 words, but you said it in a different way.
Absolutely.
But in 2011 to 13, I used to tell a lot of people real estate is overvalued in India, physical real estate. So people said population growth is there. When population is going up, how can real estate fall? So I used to tell them real estate is still overvalued because the rental yield is so low compared to mortgage interest rates. So the same thing is true today in mid and small cap. Why did this happen? The reason is very simple actually. Between 2021 second half and now, who has sold maximum? FIIs. So what did they sell? They sold large caps.
Correct.
They didn't sell mid cap and small cap. Who are the buyers? Domestic. So what happened as a result was that it was only the large caps which saw selling. Correct. And mega caps which saw even more selling than large caps. So due to this reason, what happened was that it was the large cap and mega caps which corrected much more than mid cap and small cap.
Correct.
On the other hand, mid cap and small cap saw the benefit of SIP, SAHI, etc.
Correct.
So due to that, what has happened is it is the mid cap and small cap which have outperformed the large cap and mega cap. That's all. It's simple as that.
Right. So it's just buying and selling. There is nothing fundamentally that is really changed.
Fundamentally, there is nothing wrong with mid cap and small cap except that they have become much more overvalued relative to their past. But there is nothing fundamentally wrong with them. But this whole concept that mid caps alone will do well or small caps alone will do well, mega caps will never do well.
Yeah.
These all are
extensions
of some frameworks which don't work.
Correct. Tell me anything else that you can pluck out from the experience of last year. Were there any new learnings? Anything you found that was new?
I think it is important for investors to always stay rational. And that is the challenge. Like, for example, I have not understood this entire SME IPO boom. I'm not involved in it, but I'm not understood it at all. And so, that is an area where investors should show more discretion at all points of time.
Correct.
In my reading, whenever you look at any stock, what is it that I tell people to do is just look at trailing price to earnings, look at trailing price to book. You will get an idea and you will get an idea of whether those stocks are reasonable or not. Those are all simple rules that we have used over a period of time. Those rules will still work. And I believe that, we have to always try. See, every time people think, they have to make money in the next 3 months, that doesn't always work.
Yeah.
To be rational in a big bull market is very important. And markets always give you opportunities. And that is a reality from an investor's point of view. And I think the entire mutual fund system that has been created, which allow investors to do small SIPs and get the entire benefit of the entire mutual fund system, has been very good, and you can invest 500 rupees also lump sum in the
Correct.
mutual fund industry.
Right.
And what's been happy is many of the large cap and flexi cap funds have also done reasonably well against benchmark. It is the mid cap funds which have done badly against the benchmark. And that is one thing which I noticed at this point of time. So it is interesting to see these kind of trends happen over a period of time. And I would have never imagined when I joined this industry in 2004 that the industry will keep growing in the pace it is.
Correct.
And what we have seen as our sponsor keeps saying, that you just focus on brand, trust and reputation. This industry will keep growing on a continuing basis, just like India has been growing consistently over the last decade.
Correct. And from an investment perspective, I mean, where do you see value today? You said in general, stocks are expensive, but where do you see pockets of value?
We definitely see pocket of value in mega caps at this point of time. If you look at the top 10 constituents of any index, the large cap index, I think they have underperformed bottom 10 constituents of the 500 index by maybe 40-50% over the last few years. So I think mega caps are certainly very much more interesting at this point of time.
Any particular sectors or businesses that you find particularly exciting?
I think, we have had a very broad-based rally.
Right.
And that is the reason why we believe that, we believe much more in asset allocation, due to which we believe much more in hybrid fund investing at this point of time. Because we have had a very broad-based rally. Are we in a position to say any sectors? 3 years back, as you know, we used to be very positive on PSUs.
Correct.
PSUs have just gone up substantially. We used to be very positive on metals. They have gone up substantially.
Yeah.
We used to be positive on telecom. While we may still be positive, they have done extremely well. So, almost everything that we used to be positive on pharma has done well. So what has happened is that there has to be some pocket which we can say is extremely cheap.
Right.
There is no such pocket right now. So that is why we are in a phase where, you have to practice asset allocation. And there is no choice other than to practice asset allocation, because there is no pocket. Normally, when we tell people to make mega money, we want fear.
Right.
And valuation to be low.
Right.
If you can tell me which is that area where you can see fear and valuation being low, I'm happy to tell you whether that sector is very good or not. But you are not able to see any sector where the combination of fear and valuation being low exists at this point of time.
Correct. You think the best of the PSU rally is behind us? Is it overdone?
See, I would say that it has reached a stage where you have to be more selective. You cannot broadly say that you can go and invest in any stock, whether it is in PSU, whether it is in metal. In many of the sectors which has done extremely well in the last 3 years, you have to be more selective. Like if you ask me, we are still pretty positive on all the PSUs in the power sector. Because what we see is that in power for the next 2 to 3 years, there is a problem that there aren't enough new capacities which are coming up in power.
Right.
So we are believers in PSUs in the power sector. So like that, you have to go in and look on a bottom-up basis and see whether the sector makes sense, whether the valuation implied in the current assumptions makes sense. So there are PSUs today which definitely look overvalued, whereas 3 years back, almost as a group, they were undervalued.
Absolutely. Tell me, companies like PFC, I don't know, I've not seen your portfolio whether you own them or not, but REC, PFC and all, even today trade at decent 5-7% dividend yield. I mean, they used to be 15%, 20% some time ago. Is there something fundamentally flawed in these? Would you look at them because they've gone up 5-7 times or 4-5 times? Is it time to log off? Or, this based on the yields, they still make a good case?
So we are big believers in power generation because we believe that there's a big shortage. So could you make money in lenders to power generation and power discom company is something which requires deeper work.
Right.
Because for a period of time, people used to say that the discoms are not in good financial shape.
Correct.
So that's why it's a more complicated answer. Whereas power generation companies, there are very few of them. And all of them will have a good time for the next 2 to 3 years because there is virtually no capacity at this point of time.
Right. And how about PSU banks? Because there was severe undervaluation which has got corrected over the last 1 or 2 years. Now, I don't know, do you think they are undervalued or they're overdone?
So again, time to be selective because see, there was a superb way in which they brought down their non-performing loans.
Right.
So due to that, they got re-rated now. From here, actually you have to look at it individually and see what happens to their net interest margin. Can they continue to maintain the very low level of NPLs? So there have been companies which have declared results recently where there's almost no provisioning required because their book is so pristine. Can it remain like that forever in the financial system? Even in private sector, it won't remain. So I'm saying that it becomes, we are not in this phase where anything is cheap. So everything requires work. And that is the challenge of investing. So I keep telling people the easiest time to invest is when markets are very cheap and fearful.
Correct.
And tougher times are times like today, when markets are no longer fearful, but at the same time valuations are no longer as cheap as they were 3 years back.
Correct. But as a pocket now, for example, if you look at the banking universe, all these quality banks did very well when, 2014 to 20, when PSUs were obviously, all the wholesale banks were struggling. Today you see the reverse, even HDFC Bank or a Kotak Bank, all of them now, 2.5 times or 2.4 times or 5 times book. That's the range they quote at. Is there reason to believe they can be reset to what the kind of valuations they were used to earlier?
I doubt whether they can.
Was that relative gap we shouldn't think about anymore?
See, I doubt whether they can go back to the valuations that they were 10 years back. Simply because many of them are much larger today.
So growth itself.
So, at that scale to become to have very high price to book itself becomes a challenge because each of them are today much, much larger than they were 10 years back.
Right.
Does it mean that they are all secular growth stories in a country like India? Certainly. But can their price to book keep going up? The answer is no, because end of the day, they are not small. When you're small, you can have very high price to book because they can grow at very high pace. If some of these banks were to grow at 30-40%, it would be almost impossible.
Right.
So that's the challenge that is there in some of the private banks which have now become very big right now. But does it mean is the outlook for these banks bad? Certainly not. Are they very good? Are they worth considering as investment opportunities? Yes. But can they become 4 to 5 price to book? I don't think so. I think that phase is over.
Right.
So that's why there's certain sectors, the smaller sectors sometimes are more interesting, sometimes because they can have very high valuation. Whereas some of the sectors have become mature. And that is the reality that some of the older price to private banks, which used to have 6 price to book and 8 price to book, they cannot go back to that at this point of time.
Correct. You talked about, value growth, visibility in power. So are there any sectors where you clearly see they are in exuberant phase?
See, the reality is that we have to do the work. And the challenge is there is a certain implied assumption. So, for example, this entire electronic manufacturing listed companies. So, these kind of things, the implied assumptions are pretty high. So whether those companies are going to deliver on those implied assumptions or not is the question. So, I come from a contrarian, slightly value-oriented mindset.
Right.
So, I typically start thinking whether these companies can deliver this kind of growth easily over the next 3 years. They're already implied in it. So that's how I start thinking. But it's possible that
They
we
might
are
surprise.
wrong. And at ICICI Prudential, we are trained to think to be skeptical at times.
Right, right.
It sometimes helps, sometimes doesn't work, because finally we are managing public money. So when we are managing public money, sometimes we err on the side of caution.
Right.
Slightly lower return with slightly lower risk is something which is more acceptable, is the framework that we are used to.
Right. Anything else where you have high degree of confidence from, let's say a 1 to 2 year perspective that they will do better? Of course, you called out mega cap companies, but any themes, for example, even IT has gone round, but not gone anywhere. Where do you see IT? Next year, definitely everybody is talking about a slowdown. Of course, all of this year we were talking about a US recession, which never happened. But definitely global growth is looking weaker. Last 2 quarters, the results have not been as analysts predicted. So there is some kind of softening in demand, deal closure and all of that. Would you still buy IT?
So I have been telling people, and people don't like to hear it from me, I believe we are in a more moderate return environment. Given that globally we are in a higher interest rate world, we have so many geopolitical issues on which we know nothing about. In India, we are in a higher valuation environment across market caps. So I tell people you will gain more by asset allocation and focusing on categories like multi-asset or equity and debt or balanced advantage. So as such, I believe that we should be in a lower, you should expect moderate returns. And most people don't want to hear that from us at ICICI. They want us to tell you will get high returns, and we tell them you'll get moderate returns. So it's something which people, I tell them, actually, 2 years, large cap has given very, very moderate returns. So now I'm saying across the spectrum, you will get moderate returns. Maybe in large cap, you will get reasonable returns relative to mid cap and small cap. But you are in a moderate return environment, and people don't want to hear that.
No, true. I mean, definitely the mood on the street, retail investors is that, and that's how, just 2 days of, correction in the mid-cap rally, and the third day you saw, week before last, it was back up again. So every dip, somebody is willing to put the money there and pick up those stocks.
Yes.
So there is that kind of optimism. So is this very clear that, this retail money is going to chase mid caps and small caps? That will be the space, because it's, because how do you even explain it? Today, is the Indian retail investor or even the fund managers, I guess fund managers have a bit of a problem, because if the money comes into a small cap fund and a mid cap fund, you're forced to invest in that category of stocks. How does this reverse? How does the value in large caps really get discovered, or how does it start to perform? Does it mean that the foreign investors will have to indeed come back and then those stocks will go up, or some kind of reallocation can happen?
Don't worry about it. 3 years back, when we used to buy PSU stocks or value stocks or telecom stocks or metal stocks, people would ask me, how can quality stocks ever underperform? So every day, if I had started to think what will lead to this trigger, I would not have managed to think of these stocks. So I would ask, aren't these stocks cheaper than the quality stocks? The answer was yes. What happened that finally PSU stocks or metal stocks or telecom stocks or all these things outperform the quality stocks? Now no one knows. So like that, today when people ask me this question, I don't answer them, because we don't know the trigger that results. In 2011 to 13, people would ask me, why should I not keep on investing in real estate? After all, real estate has done better than equity for the last 10 years, from 2003 to 2013. I used to say, I don't know what will make the trigger. Finally, it happened. So what we have learned over a period of time is, be rational, look at valuations. Like that, today, for example, we don't know what will be the trigger which leads to moderate return. Maybe you have given the answer. Maybe it will be that mega cap money will come from foreigners and lead to it. Maybe that's the answer. It's possible. but we don't know for certain what turns out to be the trigger.
Sure.
If you ask people what resulted in quality stocks underperforming PSU stocks, you won't have the answer.
True. Any other pockets that you can call out? For example, autos, I saw you hold your top holdings are TVS and Maruti. So what is the play? Is it just you're looking at consumption and growth from a 2 year perspective? So those look fairly well poised in terms of growth, or is there anything?
See, if you look at the two-wheeler industry, got stuck in 2014-11. 14 to 21, there has been negative growth.
Right.
So we thought that why can't we take a bet on two-wheeler industry? People say India growth story. If you have India growth story and two-wheeler keeps declining, then where is the India growth story? That was a simple call. And if you take car industry, there was one semiconductor issue, this problem, that problem. Then some of the precious metal prices went up, which were used in making many of those platina converters and all that. So we thought there is some scope. And between all the discretionary sectors, the other discretionary sectors were all trading at 50p, 60p, 70p, 80p.
Right.
So we thought, let's take a bet on a cheaper discretionary sector.
Sure.
So that was the way we looked at it. And it worked luckily for us.
Sure. So another stock, I mean, you don't have to comment on the stock, but as a phenomena, DMart, it's a great story, great business model. The market loved the stock, but last few quarters, if you see, the story has not panned out. I mean, they're growing slowly. There are pressure points, and then we see some kind of disruption happening in that space also. So in these scenarios, how do you sort of, hold on, or how do you keep your faith in a stock?
That's why investing is difficult. I mean, I can tell you when we owned power in 2020, people told us that power is gone. I used to tell them, without power, I cannot live. So I believe that investing is not that easy an activity. There are times when you'll have doubts. Sometimes you have to believe in those doubts. Sometimes you have to disbelieve those doubts and double your position. So these are the challenges. Then you have to look at what are the implied growth assumption in that price at which you own the stock, or you currently the share price is. So that's how investing is about. And if investing was arithmetic, then we wouldn't be needed. So that is why it becomes complicated. And that is where I can tell you there were people who told us this quick commerce model is gone. But now suddenly people tell us quick commerce is working. So now I don't know what changed in 1 year. People are now accepting quick commerce is working. Now 1 year from now, what people will tell us, we don't know. And how we will also change, we don't know. So that is the beauty of investing, which makes us come every day to work. And we'll have to keep thinking what we thought yesterday, what we thought today. And somebody will tell us how you change your mind suddenly on this and that is a challenge, and we have to do better for our investors.
True. So talking of quick commerce, what are your thoughts on the, all these new age companies, Zomato, Paytm, PB Fintech? All these three stocks have done exceptionally well. Nykaa, I think, is an exception, is not. So what are your thoughts there? Are they in your radar?
So we look at every stock and think about it on a bottom-up basis. And some of the new age stocks we own, some of the new age stocks we don't own. And I always tell people I'm not the only person looking at them. I find some of my younger colleagues do a better job of looking at them. See, it's like, each person, sometimes you don't understand how the younger people think of these sectors, how they use those products, etc. So we have garnered and utilized the knowledge and the thinking of the younger generation in looking at these stocks. Otherwise, maybe would have missed some of these opportunities. And so that's why I don't alone take these decisions. It is taken by some of my colleagues, and we have made money in some of them.
Wonderful. But what is the framework? I mean, what is the framework that they have come up with to evaluate? And
the framework is that you have to look at the industry. You have to look at how many players are there in the industry. Is there a long-term plan to make money in the industry? Is it a long-term plan to make money for the shareholders of the company in the industry? Then you have to understand all these things and then see whether it fits in. Then you have to see who's the seller in the stock. If you look at some of these stocks, they had private equity which needed to sell at any cost.
Yeah.
So we used
technical
all these
overhang.
technical overhangs were there in some of these stocks. So we used all these frameworks to think about it. Did we miss some opportunities? Yes. Because of our own ignorance? Yes. Did we capitalize on some of the opportunities? Yes. Both happened.
Sure, sure. One last question, which is, Geo. So do you see Geo really coming and disrupting the financial space? Is there a possibility of...
talk about a company which is entering the mutual fund industry and you are asking me to talk on it? That is very tough. See, I believe that, India has one of the best services infrastructure in the world. I think, I can tell you all my classmates tell me that India has the best infrastructure in the world. So I think due to that, you have more and more players entering every services industry. And due to that, we have a buoyant services industry. And as a mutual fund, when we are servicing our customers, we have to keep on preparing ourselves to handle our customers better and better. That's what my CEO says, and my CEO of my sponsor also says that. So that's what we have to keep doing. But otherwise, I can't talk on the question that you are raising.
Sure. Fair enough. Your top 3 picks for this year?
My top 3 picks have been very easy. I've been saying people, you have to focus on the hybrid category. And in the hybrid category, there are 3 categories which we like. One is the multi-asset category, which has gold, InvIT, REIT, exchange traded commodity derivatives. Then you've got the balanced advantage category, where we keep on talking in a boring way all the time, every day, morning, afternoon, evening. And we've got the equity saving category, which is a bit more conservative. These 3 we keep talking. Actually, the 4th is equity and debt category, which belongs to the aggressive hybrid category. So we believe that this hybrid category is the way to put money for the long term. And what happens is, by investing in them, these categories are very, very interesting investment opportunities. And over a long period of time, I believe that these are all buy it, shut it, forget it, based on the riskometers that the regulator has rightly told us to talk about. That is my...
And for anybody who is investing directly in equities, what would be?
Investing directly in equity, I don't give ideas on directly in equity. I would tell them, unfortunately, so far we have only equity ETFs in the thing. So I would any day recommend a 500 ETF. The reason being that Warren Buffett was asked once, which is the best way to invest for the long term, for a 50-year period, by somebody. So he said that the best way is to invest in a large number of stock ETF and a treasury. So that is a 500 ETF. So because if you invest,
so you're saying a mix of a broad-based ETF and treasury
and a gilt ETF.
Okay,
that is what he said. So I would say that that is what I would also recommend. We don't have a gilt ETF, I think, in our company, but this combo is what he recommended to people in US.
Okay.
So since he is both your and my all-time guru, I would say go with a 500 ETF and a gilt ETF.
Sure. Wonderful talking to you as usual, Naren. Thank you so much for your time.
So wish everyone a very, very happy, prosperous Diwali.
Absolutely. Thank you so much, and same to you.
Thank you.